Thanks, Jim. I am a longtime avid Grants reader, and thanks for the intro and the hospitality here. As Jim said, had lunch with Mr. Grant, and he asked me if I wanted to speak here, and I'm thinking to myself, you know I'm in insurance, right? I'm not sure that's the right audience, but I am very, very excited to be here. Happy to get up on the stage. I was thinking, those of you who may remember, Steve Ballmer got up on the stage, developers. And so I was thinking, I'm gonna get up on the stage, insurance, and start chatting it for 3 minutes like Steve Ballmer. But then earlier, Nate was talking about Athene and Apollo and bashing insurance, and I said, maybe that's not the best plan to start the meeting. I think it's really important to point out, to dismiss P&C insurance. I'm in P&C insurance, mostly property insurance. We are not quite the same as life insurance. We don't like having the same noun against our name. So very, very different business. I understand his comments about the life insurance in Athene and Apollo. That is not what we do. I'm not gonna talk a lot about insurance here today. I'm gonna talk specifically about catastrophe risk and the investment opportunity in it. Real quick on me. As Jim said, I started SageSure. About 20 years ago, I started a software and services company. My background had various jobs. My dad was a journalist in insurance, wrote for the National Underwriter Company for 30 years, so that's where it got from. When I was 14, I thought I was gonna be an actuary. I thought I was gonna be a pension actuary, and then I went to college at Penn, studied actuarial science, finance, and computer science. I thought I was gonna write pension software. How tantalating. That'd probably be a pretty good job today, but I ultimately didn't pursue that path. I came to New York, did FIG investment banking for DLJ, for UBS, and then found myself at a fixer-upper insurance company in Florida and learned the P&C industry, and that's where my love for the industry came in. And so born to do that, I feel like I'm in a business that I was meant to do, and then I went to work for a global reinsurer, Renaissance Re in Bermuda, and then started this organization officially in 2009, but started a software and services company focused on the same thing. So, SageSure. SageSure is a business I control. It's a business that is management owned. We write a little over $3 billion of property premium in 2025, the largest managing general underwriter. Those of you probably don't know what that is. We sit between, we're not a broker per se. We do distribute to retail agents. We do act like a broker. We control the distribution, but we also control the risk. So we manage the risk, we create our products. We have actuaries, we have meteorologists, we have product people who create the actual products and service the entire business. I'm not here to talk about SageSure quite a bit. I'm here to talk about insurance-linked securities. So I know what you're thinking. How quaint, insurance at a finance conference. While you're thinking about arbitrage, you're thinking about alpha investing strategies, we're thinking about the probability that a squirrel's gonna hit a wire and burn down the house. So you're thinking about big picture, we're thinking about small things. Probabilities 0.013%, cost $1.25. We're really excited about that opportunity. Sorry, that one didn't land the way I hoped it would. So the insurance-linked securities market. I'm gonna talk to you today about 4 aspects of it. I'm gonna talk to you about why I don't think a lot of people are in it, why it's an uncrowded space. I'm gonna talk about it being uncorrelated. I'm gonna talk about the general, we talked a lot about earlier today, Nate was talking about private equity and the lack of liquidity. Liquidity is not, to some of the recent conversations, public market liquidity, but it is strong relative to many other asset opportunities that deliver a similar return, and there is very compelling yield in it. Talked about correlation. Natural catastrophe risk is unlike most other asset classes that you can be in. Financial markets, credit crisis, all of these things are interrelated. Hurricanes do not care about our economic markets. The hurricane's gonna happen or it's not related to our economic markets. So even the biggest hurricanes are borderline irrelevant to the economy. So when you have a bad hurricane, is it really taking down the stock market or the bond market? It's not. So these aren't big enough things that massively impact the macroeconomic markets and the financial markets. ILS is 94% natural catastrophe risk. So there are other ones like, I'm not gonna be here talking about cyber ILS or talking about life and health ILS. This is about natural catastrophe risk, but 94% of the market. So it's the dominant underlying risk in the asset class. So it is a $121 billion market by recent estimates from Aon as of middle of 2025. It's grown significantly, 18% up from 2012. It bounced around a little bit. I won't talk a lot about the global reinsurance market, but I will explain how reinsurance works and how it plays into the creation of the ILS market. So I'm gonna go a little wonky here and go into each type of ILS. There are 4 types. Of the $120 billion, about $55 billion is catastrophe bonds. These are 144A securities. Give you an example so you can relate to this. USA is one of the largest issuers of bonds. Typical spread they would pay, say 5.5% to cover US hurricane risk with model probability of attachment of 1% and expected loss of 75 basis points. So these are traded every day. The funds that trade in these are marking every single day, and they're providing 7-day type liquidity. Sidecars. Sidecars are rarely traded. These are more like equity returns. We've been the sponsor of some sidecars. Sponsors are special purpose vehicles. They're 1 to 2 year type instruments, and but they give you equity type returns, usually 20 to 30% range. So they're attractive. They're very complicated. They're one of the more complicated, but they're also, it's an extremely exciting asset class in terms of the overall yield that you can get in these vehicles. ILWs, not too exciting, $5 billion space. These are often utilized by non-insurance entities to hedge their risk to natural catastrophes. Houston-based refinery might pay 8%, something like that, a high single-digit percentage, in order to get access to recoveries in a 1 in 50, 1 in 100 type year event of, say, a Gulf $100 billion hurricane, something of that nature. Again, I won't be talking about this a lot today, but this market's been around for a very long time, hasn't grown that much. Lastly, these have been around quite a bit, and they've been around for a long time, where reinsurance funds are in a GP-LP structure. We refer to them in our space as collateralized reinsurance, and I'll show like the connections to the underlying insurance. But these are institutional investors providing capital to underlying reinsurance experts who have created funds. A lot of cases, these funds are sitting inside global reinsurance organizations who are putting funds and getting side pockets of money rather than using their own balance sheets. They're using sidecar balance sheets. They refer to as collateralized reinsurance, and getting paid fees to do that at the same time and be able to deploy larger amounts of capital. Returns are pretty good, not quite as good as sidecars, not nearly as complicated, but not as liquid as instruments like cat bonds. So cat bonds are, there's a lot more information available about cat bonds. So we can quote these, we see these, you can go online and see these right now at artemis.bm. It's a leading data provider of this information. Cat bonds, SageSure, the organization that I run, sponsors currently outstanding $2.2 billion. We buy about $5 billion of reinsurance in the global markets each year and growing. 2.2 billion of that first event limit is catastrophe bonds. Those are dominated by hurricane risk, but earthquake is notable there, and you see earthquake in there, and you see international in there as well. And cat bonds, as you can see from the names on here, Allstate, State Farm, USA, these are name brands that are out hedging their overall global risk, and most of this is hurricane risk from them. And then you see residual markets, the Florida residual market, the California Earthquake Authority, and the Texas Windstorm Association as major sponsors who are hedging their underlying risk. And then on here you've got Everest, which is a global insurer and reinsurer, and Zen York, and an Asian. So you've got a little international mix in there as well. So why is this space not more crowded? I have 4 areas that I think are potentially misconceptions about why this class isn't so investable. Model risk is a huge one. There are two major catastrophe models, one owned by Verisk and one owned by now Moody's, which was formerly known as RMS. And the models are, let's focus on hurricane for a second. The models for hurricane are actually quite good. Are they right? No, there is no right model. But what you can say about these models that's very different than economic models is they're not prone to the economic bias. They're just based on what we think is going to happen in hurricanes. And I emphasize what we think is going to happen in hurricanes, not predicting next year, but not biased toward the past. We're looking at the past, what has happened in the hurricane catalog back to 1852, and how do we think that's going to play out in the future with the changes in climate, the changes in sea surface temperatures and things of that nature. So the models are built. They're not built to say, I'm going to replicate the past. Although some regulators actually force you to use the backwards-looking model, which is quite interesting. The models are built and they are used to look at what we believe is going to happen probabilistically in the future. So the models have done a really great job at estimating it. They've been around for over 35 years now. So the original models were late 80s, early 90s, and they've done quite a good job at modeling risk. Are they right? No, but they're a pretty good tool. Climate. There is no question in our minds that there is a changing climate, and there is no debate that the waters around the globe are warmer. They're warmer. So what does that mean? Does that mean that insurance is uninvestable, that catastrophe risk is uninvestable? It does not. It means we have to run models and we have to contemplate what is happening with the underlying risk. So we don't put our head in the sand and act like the sea surface temperature is what it was in the past. It's not, and that leads to things like rapid intensification. I'm not a meteorologist, I can't pretend to be, but our meteorologists on staff, we have meteorological PhDs, wind engineers, and those kind of people. And we feel very comfortable that on a year-to-year basis, we're not saying you should write catastrophe risk for the next 30 years and hope it's right. You're doing 1 year, 2 year type vehicles, and you're saying, I feel pretty good that the climate risk is baked into my forward-looking projection for the next year, for the next 2 years. 30 years out, I don't know, no idea. Liquidity risk. So we'll get into this a little bit more detail, but the liquidity risk that you have in many, we talked about private equity, we can talk about mortgage-backed securities. Can I get my money out? If they're tradable securities, sure, that's one way to get liquidity. This asset class generally trades in 1 year or 2 year tranches, especially sidecars, which are inherently not tradable, but they're 1 or 2 year risk periods, often 1 year risk periods. So you're not subject to like, oh, a year comes, I can't get my money out. Of course you can get your money out because the money is in treasuries, sitting there in money market accounts, and you can take that money out at the end of the year if you don't have a triggering event. And these triggering events are generally very remote, so we're not sitting there with exposure to, I can't get my money out unless you can't sell your money market account, which of course you can get your money out at the end of the period, barring a triggering event. So there's not really significant day-to-day liquidity risk in sidecars, sure, but not significant liquidity risk in the 1 to 2 year time horizon. And lastly, the insurance business, which I'll get into in a second, is not a great ROE business. It's not, many of you probably aren't investing in insurance. You're like, kind of sleepy, kind of boring, not very exciting industry. So why would I want to invest in insurance? And I will add the numbers up for you and walk you through why you would. I don't blame you for not investing in insurance. I personally don't invest a lot in insurance. I don't think it's an exciting primary insurance event, but mostly because the reinsurers get all the money. So the people who are taking the risk, especially in the catastrophe space, are getting all the money. The primary insurance business isn't that great. So is the insurance business by itself an adverse selection risk? I don't think so, and I'll show you the numbers in a minute. So I think the headlines scare people away. These are actual headlines, all I think in the last year. The possible collapse of the US homeowner system. Maybe a little bit of hyperbole by the New York Times there. Bloomberg, home insurance as you know it is doomed, you're not ready. I don't know, I would love to hear the audience's perspective on this. Maybe we'll talk about it in questions. It's mystifying to me where these come from, writing about 1 million customers and insuring several $billion of insurance. This isn't the world that we see. We see this being completely media sensationalism without a lot of substance. So I think of that as a great topic for this audience here. Very much a contrarian view maybe, but there's a lot of margin in this business that's going to reinsurers, and maybe the media headlines are keeping people away, but there's a lot of yield to be had here. So is this the last $100 billion plus market? That's my question. Going back to the key points, it's uncorrelated. It is compelling yield, and I will get into the specifics of what we see in this space in terms of yield relative to credit quality, relative to risk. I mentioned liquidity, whether you have tradable cat bonds that have availability to sell those bonds on a daily basis, whether you invest in funds that have 7-day type liquidity, or you do ILS and you know your money's locked up for a year or two, the liquidity is relatively strong for these kind of yielding assets. And the reality is this is a relatively uncrowded space, and many of you probably don't participate in it, and so you can understand how uncrowded it is. Okay, I promise this will be fast. I'm just gonna go through a little bit of insurance numbers so you understand the context. The US P&C market, $1.1 trillion annual premium volume. So the property space is about $300 billion between homeowners and commercial property. The catastrophe exposed portion of that, these are rough approximations, is actually about, my estimate was about $190 to $200 billion, is in catastrophe exposed areas. That is to say, they've got major hurricane exposure, so the dollars going into states along the coastline, whether it be Long Island, Florida, Texas coastline, Louisiana, and so on. I've taken the states that have this coastline, added up the premium, that gets you the hurricane risk. Then you've got earthquake, wildfire, winter storm, severe convective storm, which occurs in a lot of these areas. That's another 70, 80 billion. That's the ballpark, 190 to $200 billion of the market. So you're talking about a pot of $200 billion of homeowners writing checks to cover their homes. These are purchases they're gonna keep making. It's shocking that there's so many people jumping all over themselves to do this, given the history. So look at homeowners industry. This data is compiled. I picked homeowners rather than the broader property space because homeowners is a line tracked by statutory insurance data. So we have this data, we have it every single year, we have it by line. So I picked the homeowner space specifically because it's easier to track than property more generally, including commercial. And you look at any period, the last 5 years, the last 10 years, the last 15 years, the last 20 years, the last 25 years, it loses anywhere from 2 to 5% of premium on its underwriting margin. State Farm's underwriting losses on personal lines in 2022 were nearly $14 billion. In 2023, about $13 billion. So why are these spaces losing money? There are mutuals, there are other companies that are not necessarily profit motivated. They're motivated by keeping their agents happy, their distributors happy. That's their mantra, and they drag down the market. There's a lot of people falling over themselves to write homeowners insurance Ohio. I don't know why, but they are, and as a result, people are competing on price, they're paying a lot in commissions, they have big expense ratios, and they don't do very well. So this has not been a performing industry. I don't love this space. There are some good operators, don't get me wrong. I mean, there are players like, think of somebody like Travelers who does extremely well in homeowners. They're the exception, not the norm. The space overall doesn't do very well. And so how does that add up? Why is that interesting? Maybe that's why people stay away from the space. Last slide on the insurance primary industry to just show you the economics. So how do we get to 102? You've got losses. You've got non-catastrophe losses like fire, like water. And then you've got catastrophe losses. You've got hurricanes. You've got tornadoes, straight line winds, hail. You've got wildfires. We saw that earlier this year. You got pretty hefty operating expenses. To be clear, a lot of those operating expenses are commissions paid to retail brokers. Most of you who have homeowners buy through a broker. Maybe all of you do. Certainly the majority, overwhelming majority, over 90% of homeowners is sold through some sort of broker. So operating expenses about 27%. That varies by year and the way distribution goes. And lastly, reinsurance. So this 18% reinsurance number is illustrative of the entire country, not of my $200 billion, but of my $300 billion. So it'll add up when we talk about the next page. The margin, most of their margin is sent to reinsurers. So when you look at the gross margin in the business before contemplating reinsurance, most of that margin is going to reinsurers to absorb the volatility. That's the exciting part of the business, and that's where this conversation comes in. So how does reinsurance work? Quick tutorial. We say, in insurance industry parlance, we say Cat XOL, catastrophe excess of loss. That just refers to, I am buying reinsurance for coverage from a major catastrophe, from Hurricane Ian hitting Florida, or from the wildfires hitting California. And by the way, the California wildfires, in most contracts, is referred to as one occurrence, even though it was Palisades and Eaton Fire. Those were actually treated as one occurrence, but it varies by contract language. So generally the insurance, this is massively oversimplified, and I know it's a little complicated, but it's massively oversimplified compared to what people actually do. But generally, insurance companies are attaching at about the 10% return period, or 10-year return period, which is 10% probability. So you wouldn't expect to use your reinsurance more than once every 10 years. And they exhaust at a fairly remote probability, a risk of ruin under 1%. So how does this work out? Category 4 hurricane hits Texas. There's a $250 million loss. The insurer would recover $225 million in this scenario. Pretty simple concept. So it is, in a lot of ways, similar to mortgage-backed securities. Few key differences. As I mentioned about liquidity, Cat XOL reinsurance, most of it, the overwhelming majority is bought, is 1 year. So you take one risk period, and then you get your money out. Mortgage-backed securities, of course, are quite different that way. Unlike mortgage-backed securities, where your collateral ends up being the access to the underlying assets of the loans, in this case, you put your money in trust, the money sits there, and then you pool the money to pay reinsurance agreement if there's a triggering loss event, which happens seldom. Market size, I mentioned, is $100 billion. One of the big distinction is, of course, is there are a lot of dollars flowing through the system. When you think about loans and mortgage-backed securities, people are paying a single-digit rate, and that's all the money you have to go around to feed the system. In Cat XOL, as I mentioned, there's a lot of margin in this business, and so when you get to the remote layers, you have low probability and you have lots of margin. So I'm going to walk you through the math on reinsurance, and then we'll get into ILS specifically. So the U.S. property insurance industry, that 18% I mentioned of the about $300 billion of catastrophe-exposed property, overall property, they cede 50 to 55 billion. This is the U.S. market alone, is ceding 50 to 55 billion of premium for property catastrophe risk. Their expected losses, they run 30, 35, maybe as high as 40 in a softer market. Loss ratios, that's how much they're expected to lose on an annualized basis. Of course, that's a very volatile number. Reinsurers, of course, they have expenses. They have to pay, lots of them are offshore, so they have to pay FET, federal excise tax. They have to pay broker commissions, and they have to run their companies. Big companies, not that many employees in a lot of cases, but they still have significant expenses. What that translates to is a ratio of how many dollars are coming in to their expected losses of around 3, ballpark. And so simple math is the reciprocal of 33%. So that's the range that we're talking about here. But that's a lot of margin. So there's $25 to $30 billion of annual expected profit is sent from primary insurers to reinsurers. That is really the punchline. A lot of margin is going in there to absorb volatility. Okay, so we're going to talk about how risk, primary insurance risk, connects the capital now. Traditional reinsurance, I talked about the $600 billion of global reinsurance capital. About 500 and change is traditional reinsurance capital. This is the old school way. This has been around for many decades. What's also been around for many decades is collateralized reinsurance, but it used to be really small. It's gotten a lot bigger. I mentioned this. We're not going to talk about this in a lot of detail. You could just go in a GPLP structure, go talk to some of the major players there, and you could invest in that and get PE-type access to reinsurance through the funds. Sidecars. I mentioned sidecars, highly structured, highly complex. These are issued through investment banks, capital markets, divisions of investment banks. Some of them are insurance specific, some of them are not. In those sidecar returns, generally dedicated managers go after this stuff. We'll see how that plays out over time. Maybe they'll become more retail accessed. I wouldn't hold my breath on that. Cat bonds, much more accessible. So also done through capital markets transactions. I mentioned SageSure is one of the larger sponsors of these, certainly the largest regional sponsor of these. These spreads range all the way from a 3-handle, 300 and something basis points, up to over 2,000 basis points, depending on the risk level. But generally, they're in the 5 to 8% range. These are spreads over money market yield. So your money's sitting in trust, you're getting your money market yield on that, and you're getting the spread on top of that. And the risk levels range from extremely remote, meaning tens of basis points, all the way up to several percent. So sidecar deals, I mentioned, generate very attractive returns. Let's get more specific. Recent sidecar deals, I don't want to be overly specific here. These are 1 or 2 year investments, and the actual IRRs in those books, based on catastrophe modeling, is in the 20 to 30% range, in some cases significantly higher. These are actual deals that get done. Will those play out? Depends on, certainly the catastrophe activity in this year has been relatively benign. We're in the last day of the quarter. We're pretty clean on hurricanes for the year, so these will probably end up on the higher end of that. So the median return, I was quoting median return on those portfolios. The risk profile is an important aspect of these. Generally, they're targeting risk profiles where the probability of losing money is a single-digit percentage. You're getting equity-type returns on these. Some of you all of you are definitely better investors than I am, but I don't have access to a lot of those kind of returns in my portfolio at that probability of ruin. There's a very, very remote chance of losing all of your money, although you see in the curve that they go across the spectrum. And in a no-loss situation, you're talking returns about 40%. This is actually the quoted deal that we did earlier this year. Cat bonds. So cat bonds, as I mentioned, are 144A securities. This is the performance over the last 20 years. It's relatively steady. Generally, the market has avoided significant market drawdowns. It's not going to compete with regular equities. It's going to have some hits. Even in, for example, 2022, when you had Hurricane Ian make landfall, those bonds traded down, no surprise. The market anticipated way more losses to the portfolio than actually occurred to the bonds that were issued in Florida, and things traded down. It ended up having very few losses, and those bonds then traded back up. It also created market dislocation, and the bond yields came up significantly. So what do they actually look like? And these are you can see these in the trading sheets. They come out every single week in my inbox from various brokers. What does it look like? So less than 100%, 100 basis point yield, roughly investment grade, and these range, as I mentioned, all the way from that, which is near 1% probability of loss, to some very remote ones that are just dozens of basis points. They're printing spreads of many, many times the underlying expected loss, the underlying expected, call it cost of goods sold. So these are yielding, hold on a second here. You want to see the titles there. Those should have been on there. The U.S. windstorm and U.S. quake. So those are, windstorm is the dominated one, so those pay better. Quake is actually, for cat bond managers, quite diversifying. We don't expect any correlation between earthquake and windstorm, at least not that we've come up with so far. And so those actually trade a little bit tighter, but still extremely attractive yields. The one thing I talked about models a little bit earlier, do we really feel super confident about quake models? Certainly not as confident as we do about hurricane models. Earthquake, dramatically less frequency, so it's really hard to feel the confidence that we understand earthquake frequency in the large scale of things that happen once every few decades or in that approximation. Whereas windstorm, we have hurricanes happening every single year, so we have a lot more confidence in understanding frequency and severity of those hurricanes. On the double B, the 100, 200 basis point range, of course, higher expected loss, so lower multiples, but still very attractive spreads. So we think this is a compelling asset class. So last slide, and then happy to take any questions. This is an uncrowded trade. The market will continue to grow fairly significantly from 120 billion. Would expect it, maybe it approach 200 billion in the next 5 to 10 years. I mentioned uncorrelated. It isn't going to be influenced by the macroeconomic cycle. Liquidity, it's not public market liquidity, but 144A helps, or the short duration helps. And lastly, just saw the yields. They're pretty compelling compared to similar credit. With that, happy to take questions. Yeah, so the question is, how could weather forecasts be accurate over long range? So I don't think anybody thinks, even 10 days, anybody has any prediction power in hurricane risk. If you're referring to my statements earlier about confidence in the models, I don't think they're right. I think the predictive power in estimating probabilistic frequency and severity meaning both the underlying wind speeds and the wind footprints and the damageability of structures in the face of those wind speeds is indicative of what we believe the actual probabilities are. Now, are they right? Of course not. But we think they're indicative of what that is. And the models themselves don't predict 1 year. They sample over hundreds of thousands or millions of years and say, roll the dice, which year are you going to get this year? And they're doing that based on what they believe the next several years are going to be. Yes, I believe that.
Could you explain that distinction?
Sure. Good is you believe that it is representative of the sampling of probabilistic outcomes that we have. Accurate would imply that we know what's going to happen this year. If you look at the correlation of meteorologists, whether it be Colorado State or all the weather forecasters out there, the correlation of their hurricane predictions, even for the year happening in June versus the year, they have no accuracy. So in that context, maybe it's the wrong word, but they have no accuracy in predicting that current year versus the model itself saying over the next 5 years, what is the probability of having a hurricane of this level? That probability, it's probabilistic versus deterministic.
And this draws on history from prehistory, you were saying. It goes back.
The hurricane models used the hurricane catalog back to 1852.
Oh, I thought it was thousands of years. Okay.
So they're taking the hurricane catalog,
yeah.
And they are, there are meteorologists and people who build these models that would do this 1,000 times better than me. But what they're attempting to do is take that history, they're attempting to look at that history into the future based on things like higher sea surface temperatures, based on clustering, based on rapid intensification, and these other meteorological factors. And they're saying, give me a distribution of what this year could look like, what next year could look like. That's what they're attempting to do. Yeah. And I think they're good at that. I don't think the models or anyone has produced significant predictive power in their forecasting of this year or any year. Their correlation on number of hurricanes, not to mention landfalling hurricanes.
But if I may dominate this question one more time, how does this figure into a related but not necessarily financially germane question of a highly politicized question of how we think about the future of climate change? There are all these models that would tell us that in X number of years, the ocean temperatures will be so much warmer. But if what you're saying about the hurricane models is there's basically no predictive value to them, how can we be sure about the arc of climate change?
Well, I for one would never say I'm sure about the arc of climate change. So,
but certainly people in the world of politics are pretty sure that we're on a track to extinction, no?
So, as I was attempting to mention before, the long term, what is going to be like in 30 years? What's the probability of having a hurricane in, if you ask me, let's price out hurricane futures for 2049. I would not think the tools that we use are well suited for that at all. I think what they're well suited for is in 2025, what's the probability of having a landfalling hurricane hit a portfolio, hit a geography, and cause damage to that portfolio and settle claims such that we have to pay dollars to reimburse customers for their losses? I think that's really what it comes down to, differently than accuracy of, hey, this is how many hurricanes we're gonna have this year.
A more prosaic question, and it's a two-part question. First, clearly most of the capital comes from traditional reinsurers. So presumably a lot of these are risks that the reinsurers find marginally or less attractive by their criteria. So how is that priced in terms of prospective return, and how much of this is based on, to some extent, disintermediation of corporate forms, because I gather these things are done as direct debt obligations as opposed to entities that have to pay corporate tax?
Yeah, the buyers of these, in terms of paying corporate tax, it's a great question. There's a myriad, I mean, a lot of them are onshore US funds. I'm sure the taxation there is based on their owners. But to get your more important part of the question in terms of traditional reinsurers, catastrophe bonds are essentially competing side by side with traditional reinsurance. There is definitely no adverse selection in catastrophe bonds. What catastrophe bonds are doing is coming in and crowding out traditional reinsurance. So what we've seen, for example, in the last several years with the traditional reinsurance markets, having been in these markets and buying $5 billion of cover, we put out to the market, say, hey, cat bond market, what do you want? Hey, traditional reinsurers, what do you want? And we're just putting them side by side. And generally, the cat bond markets have come in tighter and knocked out traditional reinsurance. There aren't that many players doing that yet, but I think that's going to be an increasingly frequent phenomenon. Traditionally, the cat bond investors want to back low probability risks. So they like that yield and feeling like it's very, very improbable, whereas traditional reinsurers are like, fine, take it. You guys can take your 1% probability. My capital costs me too much. They need equity type returns on their capital, so they tend to play lower down in the more working layer tranches of risk, above the 10-year return period, but below the, call it 50-year return period. Did I answer the question?
Larry, thank you. Yeah.
Thank you.
Terrific.